Welcome to the link, this week's edition. We are always happy that you give us feedback on the things we discuss, and I asked again that if there's something you want to learn, you want us to find out for you answers on the link, feel free to reach me out at SETSAM, at SETT Sam on Twitter, and we have a chat and we see what we can do to help you. Welcome tonight again, and tonight we're discussing real estate and the law. URA and government is serious these days on those who own buildings, apartments, rentals, and so on. And tonight I have Mr. Alex Matovu. Mr. Alex, just introduce a little bit yourself.
Okay. My name is Alex Matovu.
Yeah.
I am a managing partner at a firm called Signum Advocates. I'm also a board chairman at Credo Management Limited, which does property management.
Okay. Yeah. So you're qualified to talk about law.
Oh, yes. Oh, yes, I am.
Alex, welcome. What taxes should I be aware of as I invest in real estate today?
Yeah, okay. For starters, I think it's to start with, really, I know you're talking about the real estate sector. To understand real estate, not to just mean buildings, but also the land on which the buildings are located. I think people think of, when you say real estate, they think only buildings, but even the land. So the first tax you have to think about really is when you're acquiring the land, what do you pay? We all know if you've transacted in land that the first thing you pay is stamp duty, which is 1.5% of the value of what you're purchasing. So if you're looking at it as a business, that is going to be your first cost in relation to tax. It's 1.5%, and that value is not the value at which you bought the property. No. It is the value that the land registry or the chief government valuer's office will give that property.
So it could be higher even?
Certainly. Most likely it is going to be high. And I've had debates with people who say, you know, this thing is not even worth 10 million. Why are you getting the valuation and telling me it's 30 million? And I tell them it's the chief government valuer to decide. But even when you get to building, to setting up this property, you're going to be dealing with a number of different taxes, and I think people mix them up. There's what we call rates, there's what we call tax. Rates are imposed through the municipal laws that we have that will impose a certain rate, and we'll call it a property rate. I think the rationale behind that is the services that the municipal councils give, cleaning, garbage, and all this stuff that they will do.
Grading
they
roads.
Will charge, So those roads that are supposed to be maintained by them, you're supposed to pay a property rate. That rate is not dependent on how much you're earning from the property. They have their own formula that they will use to apply, even if the property is vacant.
It's arbitrary, however.
It is no, it's not arbitrary. There are instruments of law that allow for that rating, but they're not based on the income that you're earning. No. They're based on their valuation of the property as a whole. But maybe it's important to note that they're not payable by residential holders of land or property, but when it is rented out. For rental tax, on the other hand...
Explain that. When it's rented out, explain that.
Now, what I mean is, if I build my house and I'm sleeping in it, I will not pay a property rate. I will not be valued. So those valuations normally happen after 5 years, and when you're paying, you pay annual. You pay once a year. Rental tax, on the other hand, is based on the income that you're getting from the property. It's actually an income tax. There's no law called rental income tax. The law is income tax, but when the drafters of the law came to real estate, they crafted a specific tax called rental tax, which is from rental income. Now, how do we get to know the calculation, or how do we get to know how much the rates are? The law currently, as it is before the amendments they're suggesting, which we'll get into later, is that if it's a company, it will be charged 30%. And that means one company can own 30 properties, and it will still pay rental tax at once. Its deductions or allowable expenses will not be limited, according to the law as
if it's a company.
If it's a company. If it is an individual, there will be an allowance of expenses up to 20%. Now, under the law, in general terms, you should be allowed to deduct certain expenses that are allowed under the law, as long as they were incurred in generating the income that you're reporting or you're paying. You're paying tax on. But when it comes to rental tax for individuals, it is capped to 20%. Meaning spend all you want.
Even if I renovate
exactly,
and I am at 100%.
Yes. You'll be limited to 20%. So otherwise, what tax planning would require for us that will advise you on real estate tax, will tell you that it's better to own these properties as a company. That's with the current law. Because then there's no limitation on deductions or allowable expenses.
Okay, that's interesting.
Compared to the individual. Yes.
Okay, very good. So, Incentives. Let's talk about incentives.
Yeah.
You have hammered down the issue of taxation
Yes.
On the rental side.
Yes.
Or before we go to incentives, what does that therefore mean for me if I'm going to think about investing in rentals?
Yes.
Let's just round up that issue.
Yeah.
The so what?
Yes. So basically, you don't have to think of rentals as the investment that I make and there's nothing to worry about. I think that has been the general impression. If I can't run a business, let me put money in rentals, I'll just earn my money.
It's not like that.
The taxman is going to come down on you. Lately, there's investigations around who owns what, who owns which property, and there's a lot of technology that has even been invested in just finding out. So it is not correct for us to think, there's no problem, there's no expense. I think it's only fair to say that when I earn this money, apart from the maintenance and the other expenses I'll incur, there's going to be a tax component, and think of that component in terms of property rates and in terms of rental tax. For property rates specifically, you'll have to wait for an assessment normally. So, assessments may take the next 5 years and no one has come after you. But for rental tax, the expectation is that at the end of every financial year, in addition to your other income, employment income, business income, report that rental income specifically, how much you've made, deductions according to whether you're an individual or a company, and then apply the rate and pay.
So I must have at least basic books.
Exactly. You have to have the records because the URA right now allows for self-assessment. What people don't realize is that then there's a possibility of URA saying we're going to audit you. So some people will say all the money I've earned, I've spent.
Sure.
And that can be questionable because then you'll need to show the record. So even if you're an individual, it is important that you actually record income, expenses, expenses, and then you move on.
Okay, very interesting. Now let's move on to incentives,
Yes.
Alex. Incentives in investing. People think tax. Now you have talked about it, but are there things that are in the law or policy that attract me to the sector?
Yeah, I think that to be honest, you wouldn't say there's anything specific that would attract you to the sector. The incentives that are given in the sector relate to import duty when you're importing construction material, excavators, machines that will get into that. So normally it benefits the people that will manufacture the materials that you'll be using in construction.
Okay.
Now the argument there can be that the policy would be that then the cost of construction should go down.
Absolutely.
That should be what informs the policy. It is not an incentive directly to you as a real estate developer. The other incentive you could talk about maybe, and why you see many buildings coming up owned by the same individuals, is with the current law, unlike the amendment that we are going to talk about. The current law allows you to use if you're a company, to use the expenses incurred in constructing one piece of real estate to be reported as an expense that is allowable to reduce your tax payable.
Say that again, slowly.
So what I mean is this. I put up a building at 1 billion shillings. I want to put up the next. I go and borrow money, or I have my own money, and I'm constructing.
Yes.
What I will do is I'll put all these buildings, the two buildings, under the same company.
Okay.
So the expenses I'm incurring in building the next, because this company is a real estate company, can be accounted as expenses of the company. You see, that's the benefit.
Of the company?
Of a company. So the incentive is to the company that you can allow for that.
Not me.
Exactly. Now, when we talk about amendments later, you'll realize that the proposal is to get that out, which means incentives are actually being taken away.
Let's talk about the incentives. Let's adjoin.
The amendments.
So the amendments, sorry.
Yeah.
What's the amendment?
Yes.
Or amendments that I should take note of now?
Yeah. There are about 3 critical amendments. The first one is the fact that government has proposed to have the same rate for an individual and for a company. What that means is that unlike what it was before, which was 20% on the individual and 30% on the company, now the issue is to say, can they be the same? Why? Because in law, a company is a person.
Yes,
so if we are so we should not be talking about natural person and then because then people will sneak and move into. So those that are individuals will be disadvantaged. So the proposal now is to have 30%. As the tax rate across the board, whether company, individual, or partnership. That's the first thing. The second thing is the allowable deductions. Now, unlike before where a company was allowed, individual was allowed 20%, a company was allowed 100%, unlimited, okay, of all your allowable deductions. Now, it is limited to 60% for all.
Just threefold.
Now, what that means also is that no matter how much you'll incur, back then, as a company, you would report all expenses and they'll be deducted. Now they're going to be limited to 60%, or that's the proposal if Parliament allows it.
Another day we'll come back and ask whether that's fair.
Yes, the third, exactly, we can discuss the fairness. The third thing is on apart from the deductions and the whatever, it's also a question of if you're constructing, you're going to be required to account, or the proposal of government is to account for each building on its own. Mm-hmm. What that means is that if someone owns one building, wants to put up the next, if there are no expenses incurred on this existing building, there will not be any allowable deduction. So you cannot use the expenses on another piece of real estate on an existing
as it was previously.
So you are filing returns for each building. Now the problem there obviously is going to be the cost of compliance.
Yeah.
Because imagine you've been filing one return for all, even 10.
Yeah.
Now a person who has 20 buildings, who is running it as a real business, like someone in agriculture or any other, having to file a return per building, you really feel how cumbersome it will be. Now, you imagine that if you're encouraging people to pay tax, that's something that really should have been thought about. I think the policy behind it is to say, let's not use expenses in other things to come into, because that way, government knows they'll be losing. Yeah. Government knows it will be losing money. Or if here you're building, you'll always keep postponing your expenses. Yeah. So it's understandable. But the cost of compliance, but also the fact that it's a sector that doesn't have many incentives, you imagine that's the least you could do. Yeah. Because ultimately, when these buildings are put up, it's not just income for the owner of the building. There's employment that is provided as a result. We still have a housing deficit. So as a result, it does not come out clearly if you want to benefit.
We're running out of time, Alex. I have about 35 seconds. Yeah. If I came to you, Alex, in your special, what do you help me to do if I'm a player in the real estate sector? Okay. Expertise.
Yeah. So for me, there are two areas. First, it's the legal side, which is advisory. And what we do in that, we do tax planning. Tax planning is to say, what is the law? Now, we've been discussing the law, but that's just the surface of it. To go into the detail to say, where best should you be investing? Two, if you're getting into this particular real estate sector, are you aware of the whole regime, both tax and whole regulatory? But also on the side of management now, with Credo Management, the company I told you about, it's mostly about now the management and the compliance. People are very busy. They invest in real estate. They don't have the time. So what we help them do is to help them be compliant and also ensure that they are benefiting from their business well in the safety of their work or anything else that they're doing.
Okay. You see how time is making us go fast? Yeah. What to do. Viewers, that was Mr. Alex Matovu, legal but also on the real estate side. And if they were looking for you, how do they find you quickly on social media? Yeah, they would find me at Alex Matovu. I think on Facebook it will be Alex Matovu. On LinkedIn it is still Alex Matovu. Okay, that is easy. Twitter I'm not as active. Okay. But also our website is www.signamadvocates.com. So by all means, when you get to the website, you'll be able to see it. Okay, Signum Advocates. Don't forget that. That was Mr. Alex Matov sharing his expertise in this area. You might be thinking rental, you have some savings, NSSF time has come, rentals. Remember, there's going to be cost. And if you want to make the right decisions, find the experts like Alex. That was the link. Thank you for joining us tonight.